Kamau says, any thoughts on doing a weekly debit or credit spread, a bullish trade on SPY or SPX with a small portion of your account? My thoughts are just to continue to roll. I do get that there's a possibility of losing all the money in the trade, but if we keep the dollar amount in line with our account so that one complete loss doesn't wipe us out, 1 to 2% rule, is that viable? It's viable, Kamau, but you've got to think about what your returns would be. Okay, now what do I mean by that? Let's take SPY as an example because it's easier to view. I'm just going to go to the bull put credit search real quick. Now, my probabilities here were 85% or higher. We're going to clear the filters. We're going to look at all expirations, and of course you could use the dailies too, but let's stick with the weeklies because that was your question. Weekly debit or credit spread, bullish, on SPY or SPX with a small portion of your account. Okay, so let's go 0 to 8 days out in time. Oh, sorry there, folks. Let's go to 0 to 8 days out. No, I'm going to go 6 to 8 days out in time. I don't want to get pummeled with the dailies on SPY, so I'm going to go just 1 week out in time, 6 to 8 days out in time. I'm going to put a probability in, as you mentioned, start where I start, of 85% probability or higher. And I'm going to go into the fundamental section here, Kamau, and we are just going to put in SPY. No other filters, no minimum net credit, no minimum return. Let's go ahead and submit that. Probably going to get a large amount. I might have to, no, did it exactly what I wanted to the 19th, 7 days out. We have 285 results. And of course, we're seeing here a 13% return. Net credit of 12 cents, 657. So we're going to 646, 640. They're single strikes. Let's pop that up. No, single strikes are good. Those are good returns, 85% probability. I'm actually going to put my spread width at 2. It's just my preference. You could leave it at 1 with a simple search, okay? Strike difference is greater than or equal to 2. That's probably going to cut it down to 130. Oh, 263. It didn't cut it down as much as I wanted to. All right. So we're seeing good potential returns here. Now, we have an 85% probability. And we have a 13% return. Some of these 80s and 90s, we're going to a 9% return. That's because naturally your volatility is much lower on SPY than some of the stocks we were looking at on the default search, the Credo position that David mentioned, as well as, I'm sorry, some of the other ones that we saw. UNH was in there, probably higher volatility. But that's okay. These are good numbers. The bid-ask spread is probably really tight. So we're seeing some good values here. We're going to take this 13% return with 86, the 646 and a 644. This one here is a lower return because it's a 3-point spread, still using the 646. And here's your 4-point spread. Yes, the 1-point spread does give you a tighter one. I always like, higher return percentage-wise. The 646 as we saw, 645 was somewhere up in the 13.5, wasn't it? But that's okay. Bid-ask spread, we're just going to go to the profit and loss chart. I'm going to evaluate this very simply. Okay, that's great. Well, it's probably going to be 23 cents. Let's take this 5 out. Okay, it's probably going to be 23 cents. This going to put us right around 12.913. Yeah, 13% even. Okay. Well, that's all well and good with 646. We're only 9 points away. My math is terrible today. 11.63 points away. Whereas on the other stocks, we are further out of the money. Why? Because number 1 was 2 weeks out, and number 2, we had that higher volatility there, so we were getting a higher return. But this is still a decent return. Now, when I talked about requirements, when I talked about that I'm only using about 15%, 12 to 15% of my total portfolio in the bull put credit spreads, and then I mentioned that some weeks I might open 4 out of the top 6, or I might open 3 out of the top 5. Why? Why 4 versus 3? Well, some weeks, this week, for example, let's say that I had 2 positions expiring, but I still had 1 open for next week's expiration. Come Monday, I'd open 2 more, possibly 3, for the next following expiration, for the 26th. I still have 1 coming up on the 19th. So it kind of staggers itself that way. And sometimes I still have 2 spreads open, which means I'm likely only opening 2 more spreads for the next following cycle out, depending if I did any adjustments, closed a position early, or anything along those lines. The concept of why is that when I started off initially doing the testing, I found that if I was using 15% of my portfolio, I wanted to allocate 5% of that to each position. So I had 3 positions open. Some got closed early for near 90% profit. Some I closed early before because maybe they're taking the loss. They hit my trigger, and so then I might open another position for the week beyond this one. You know, so take off one. Now I have two, and then I have one out here. Then I hit this expiration, and so the next Monday I have one expiring that Friday. So am I opening three, or you know, and so on? No, I have two open. Do I open only two? And sometimes I have none open. In a good market run, I've closed all three early, so I might the next month use 15. And it's still at 5%, but if I'm opening four, naturally, what am I doing? We're cutting that down. It's going to be less than 5% for each one, because I can lose 100% of this. Now I'm using stops and I'm watching them, so I'm making sure that if I do hit a loss, you've heard me talk about this in the other bull put credit spreads, I don't let it go beyond 50% of the maximum loss. This I wouldn't allow to go beyond 88 cents or so. Loss on the position. Took in 23. I'm going to close it if it hits 88. Some people just use a simple value of twice the original net credit or 3 times the original net credit. I've just found that with this approach that the 50% rule still works out fine, and you're still right 85, 86% of the time. I think I'm 86.8. In any case, okay. Don't know your account size, so don't know 1% of what your account is, Kamau. But here's what you're talking about. You're talking about 23 cents, 18 cents per contract on a 2 or 3 point spread, weekly series with an 85% probability. How many contracts? Now you're getting 13%. Don't get me wrong. We focus on the percent. I get it. But is the monetary amount what you're looking for with that strategy? Is the percentage return amount what you're looking for with that strategy? Are you going to be right on a week-by-week basis 85% of the time? I actually, with my testing, with my approach, looking at stocks, not just SPY, I found that to going week by week, because you're going less out of the money than I can with going 2 weeks at a time with an 85% probably, we might down to the 640, maybe even the 639, potentially 2 weeks out of time. We'll check that in just a moment. But you've seen a lot of flux week by week with the news. Now we're settling down a little bit. We're hoping for the rate cut, things of that nature. We had that disastrous March to April. We've had a lot of flux up and down with news that came out, global news, economic news, jobs reports, things of that nature. And I found the weekly options trying to go week by week with that same criteria I used for the bull put credit spread had a lower probability over the same course. You could take in more flux with the 2 week out, more flux in the market, where the 1 weeks were getting violated because you were closer to the stock price. But yes, proper money management, 1 to 2%. That's perfect. That's a good approach. You might want to go maybe 2 or 3% again. Now that you kind of take a look at, create that search and power options, real simple. Bull put credit spread, 6 to 8 days out in time. Now, you'll have to change that during the week. That's the problem. I can't set just this week's expiration. I can screen for all weeklies and then sort it by shortest expiration, sort the results by expiration date if I wanted to, highest or lowest. You could do it that way. But the dailies are defined as a weekly from the exchanges. So you'd see all the daily options. So if I'm running a search on Friday, I'm doing it this way. If I'm running the search on Monday, I'm doing all expirations, and I'm going, I think, 4 to 6 days out in time, because technically 5 days away when we pull up on Monday, right? So I'd go 4 to 6 days away, or maybe it is 3 to 5. It's 4 days away. Yeah, I think it's 4 to 6. So I'd put it that so you're just focusing on the Friday for SPY. You're not getting inundated with all the different daily options. Put in the probability. You don't have to worry about liquidity with these. These are all heavily traded, so you're not going to have that problem. And then go to the fundamentals and put an SPY. Now, same thing. I know that, 7 days out, so 14 days out. So I'm going to do 13 to 15 days out in time. And I said the 85% probability. Let's check this before I misspeak myself. Come on. We saw the 85%, 86% with 13.3% return, and we're at the 646 strike. That's the 85, 86% for 1 week out on SPY. It's the 646. Now let me go to the 2 weeks out with the 85% probability. I said 639, just a guess, 640, 639. 642 is the 85.5. 640, where are you? You're 88%. Okay, so I was off by a little bit. But again, it's a couple extra points below, 4 more points lower. I know it's not a lot, but still 12.7% return with an 85.5%. So naturally, I know. You expect the higher annualized return with the day-by-day or the weekly options. I'm not trying to say that. I was just saying that through my testing, I could take a little bit more swerves in the market, even over a longer time frame in this case, and still got the 85, 86% probability over various years, whereas the weeklies didn't do that as well for me. But that was mostly on straight stocks and not SPY. SPY probably comes out to about the same. With if I'm doing weeklies and 85% probability, I'm probably hitting 87. If I'm doing 2 weeks out, I'm probably hitting 86 is my guess, just off the top of my head. Because the lower volatility, no effective earnings, no effective CEO news, or getting caught at a Coldplay concert or anything along those lines. So yeah, much more stable, much more along those lines. 1 to 2% is a good rule of thumb. I just want you to take that trading plan and say, hey, okay, double digits every week, 11, 12, 13%. I'm getting 23 cents per contract. So the question is that still matching your trading goals? It probably is, but that's what I'm pointing it out. Oh, Kamau, so it says he has a follow-up question. With volatility, as you were saying, recently, would adding a put to help protect your multiple weekly bullish spreads make sense? Yeah, and we've talked about that as a hedge. And commonly what I'm doing was we're in a stable market. Let's just go to VIX real quick. And yeah, I'm going to go to this one again, ACP here. Let's load it up, see if it gets to VIX. This did have a problem. Yeah, okay, there. Oh, yeah, okay. Commonly, and you can see this too. Let's go to, I'm just going to go to YouTube channel very quickly. And let's see here, market hedges for unexpected events, earnings, and more. All right. Review of VIX as a market hedge. So 12 to 15% of the portfolio traded in a bull put credit spreads, 3 to 5% into each one. So maybe having 3 to 5 trades open at a time. I'm sorry, 3 to 4 trades open at a time, Kamau. Now, instead of buying puts on the stock, because that changes the dynamic, and instead of buying puts, let's say on SPY to help protect your weekly bullish spreads, if you do that, you're actually what? You're converting it into a ratio back spread or some kind of 3-legged trade. You're taking away from that, maybe buy a put further out in time. One market hedge that Ernie and I use is typically when the VIX starts to fall below 15, 14 now. That's our new number. For me, it was below 13 or at 12. I'd buy 45 to 60-day out calls on the VIX for the unexpected event to hedge my bullish spread portfolio. If suddenly news came out, like we saw things in the Middle East occurred, when that happened, the volatility spiked, the market pulled back. Some of my bull puts were in position, but 2 to 3% was put into the VIX calls. I apologize, was put in the VIX calls to hedge the potential of the unknown. Usually going, Ernie, I think goes 30 to 45. I'm closer to 45 to 60 days out of time. I think I'm closer to 45. He's sometimes 25 to 35 days out in time. But we both look for the same thing, buying an out of the money VIX call, commonly a delta of around 0.3. And we use that as our hedge. And if we start to see that it still keeps going down, I mean, we haven't been down in the 11s. Remember when it was at 9? Remember when VIX was at 9 years and years ago? We think it breached 9 and went down to 820 at 1.830. Wow. We were just up at close to 50 or 60 just 3 months ago, or 4 months ago, excuse me, back in April. I mean, it's so amazing. 5 months ago, really. But, that's kind of the things here. That's one way to do it. But other ideas. You're trading SPY. And so what I'm saying is, hey, this is my weekly spread for SPY. But to protect it long term, I'm going to buy a deeper out of the money put for my multiple weeks. I'm going to go 35 days out, October 17th, standard expiration, if I'm not mistaken. And I just want something cheap. Not a lot of cheap out this far, is there? But some things that are cheap. So we were targeting these 644s. Let's go to 620. It's still pretty darn expensive. Now, I'm getting 23 cents per week. And I'm going to buy an option that's 35 days out in time. So that gives me 5 weeks of roughly 23 cents. And I'm adding protection of 226. So I'm trading SPY in this case, right? So adding this put creates a whole different level. of spread. This is what you've got to watch out for. Did you buy it on QQQ? Well, I don't know, because if QQQ is rising while SPY is falling, it's not going to help you. So those are just some, I'm sorry, Kamau, those are just some ideas. Recent look at market sentiment, VIX trades, hedge discussion, comparing hedge strategies. This is one I really like from 4 years ago. Using a bear put debit as a total portfolio hedge, we compare it. You can see here kind of on the graphics, a little small, I know. But we're comparing this against, this came in is using SPY bear put debit as a entire market hedge, portfolio hedge, I should say, not just for one section of it. And we compared that over the same time period against VIX calls, buying puts directly on SPY, and I think doing, can't remember what it was, bear call credit spreads on something. And the bear put debit he did work well because it was a muted sort of declined market. It wasn't a sudden drop where the VIX would have outperformed that approach. So we show it as a viable approach, but it's not for a major decline. Right? The idea is I don't want to buy puts on SPY to protect my portfolio and put all that price in. I want to do a bear put debit spread so I'm getting something back and the cost is less. But now your protection is also capped, right? It's capped by the debit spread. If the stock falls the index or ETF drops 3, 4, or 5%, Kamau, the debit spread is going to look really good. If it drops 8, 10, or 12%, the market drops 8, 10, or 12%, VIX calls, puts directly are going to protect much better. It all depends on the movement of the uncertainty, which we don't know. But here's some good videos for you to check out. That's what typically Ernie and I do to protect those hedged, leveraged portions of portfolio, usually using VIX calls. And you can see some of those basic information of what we look for here, again, in those videos on the YouTube channel under our playlist, Market Hedges for Unexpected Events. And in addition to that, you can see some of our other discussions on the bull put credit spreads, criteria, management techniques, allocation in the full playlist for bull put credit spreads, strategy, tools, criteria, and much, much more.